If you've been tracking regional banks lately, you know it's a sector that is just full of shifting narratives right now. But today, we're zooming in on a really fascinating story. We're going to break down the fundamental drivers, the underlying business model, and the potential risks behind NB Bancorp's recent surge in the stock market. Shares of NB Bancorp, trading under the ticker NBBK, recently smashed through to a brand new 52-week high of 24 bucks. Now, whenever a stock breaks through a ceiling like that, especially in our current, let's just say, complex macroeconomic environment, it immediately begs the question, what exactly is fueling this momentum? Are we looking at pure market hype, or are there solid, undeniable fundamentals firing under the hood? In this explainer, we're going to find out by tackling the 52-week high, looking under the hood at the Builders Bank, breaking down their Q1 earnings, exploring the bearish headwinds, and wrapping up with Wall Street's verdict. Okay, Section 1. The 52-week high and the market hype. Let's jump right into the headline numbers. So, $24. Hitting that mark during midday trading recently wasn't just a random blip for NBBK. It was actually a massive milestone that pushed this regional holding company's market cap right past that crucial $1 billion threshold. That's a clear signal. The market is aggressively pricing in something highly optimistic about their post-IPO trajectory and future growth. And get this, the surge didn't happen in a vacuum. It was backed by a huge vote of confidence from inside the house. Back when the stock was trading lower, CEO Joseph P. Campanelli personally scooped up 3,000 shares for roughly $57,000 at an average cost of $19.18 a share. You know, legendary investors like Peter Lynch, they absolutely love seeing this. When the chief executive puts their own hard-earned capital on the line, it sends a powerful message to everyone that management truly believes in the runway ahead. Moving to Section 2, the Builders Bank, under the hood. Before we get lost in the spreadsheets, we have to understand the actual engine generating this cash. Operating locally in Massachusetts as Needham Bank since way back in 1892, NBBK runs a hyper-capitalized, high-touch model. They're literally known as the Builders Bank because they heavily specialize in commercial real estate and construction lending. But here's where it gets interesting. They aren't just doing your grandfather's traditional loans. They've aggressively expanded into niche, high-yield markets. We're talking banking and payment platforms for the cannabis industry through networks like Mosaic and Cordero. Plus, this entire capacity was massively scaled up by their acquisition of Provident Bancorp and BankProv in late 2025. They're essentially building a highly specialized economic moat. All right, Section 3, Q1 earnings breakdown and the bull case. How is this specialized model actually translating to the bottom line? Well, the bull case here is super clear. GAAP net income practically doubled quarter over quarter, jumping from $7.7 million up to $15 million. Net interest income also rose over 10% to $64.9 million. But the real kicker, their net interest margin actually improved to 3.94%. Think about that for a second. In a banking environment right now where so many institutions are just getting crushed by the cost of deposits, NBBK is showing off incredibly disciplined asset growth and real pricing power. And the foundation supporting this is just massive. We're talking $7.23 billion in total assets, backed by $6.21 billion in total loans, and $6.1 billion in deposits. They're sitting on a tangible equity to tangible assets ratio of over 11%. For the Warren Buffett disciples out there, this is your classic textbook margin of safety. In plain English, they have tremendous liquidity, a huge capital cushion, and the lending power needed to just keep gobbling up market share. On top of all this, they declared a quarterly cash dividend of 7 cents per share. Sure, it's a modest 1.2% yield, but keeping a steady dividend payout ratio around 18.5% while actively absorbing a major acquisition, that tells us management is highly confident in their predictable cash flows. Now for Section 4, the bearish headwinds and the friction. Because look, no stock goes straight up without hitting some turbulence, right? While that $15 million GAAP net income looked phenomenal on the surface, we really need to look at the underlying operating net income. It actually dropped from $21.2 million in the previous quarter down to $15.8 million. Why the drop? Well, it's largely trailing merger costs from the Provident acquisition and some non-recurring fees from expanding their business lines. Integrating a new bank is never cheap, and it always creates a ton of short-term noise in the financials. Another headwind analysts are definitely zeroing in on is rising credit costs. The bank had to take a $6.3 million provision for credit losses in Q1. That is a pretty stark contrast to the $1.1 million release they enjoyed the quarter before. Annualized net charge-offs hit 0.91% of average loans. Now, they do have substantial coverage, but rising non-performing loans in a portfolio that is this heavy in commercial real estate, that's a metric that demands our attention. And because of that front-loaded tech spend and the ongoing merger integrations, their operating efficiency ratio crept up to 60.06%, compared to about 53% previously. Higher efficiency ratio basically means it's costing them more money to generate a dollar of revenue. It's a vital operational metric you'll want to watch closely as they work to streamline these newly expanded operations. Finally, Section 5, Wall Street's verdict, looking ahead. With the bull and bear cases laid out, where is the consensus? Even with the near-term volatility, the credit noise, and those integration costs, analysts are giving NB Bancorp a consensus buy rating across the board. We've seen recent upgrades from firms like Zacks Research and Wall Street Zen, which really signals that the street firmly believes the long-term earnings potential is going to heavily outweigh the short-term friction of the merger. Averaging out the projections gives us a 12-month price target of $25.50. Considering it's been trading in that $23 to $24 range, we are looking at an approximate 11% potential upside from here. Clearly, Wall Street thinks this hypercapitalized model has plenty of runway left. And guys, this isn't just talk. The smart money is literally voting with its wallet right now. Vanguard Group bumped their position by 18%. Dimensional Fund Advisors increased their stake by a staggering 81.4%. And Teton Capital Management just acquired a brand new $10.4 million position. Institutional investors are actively loading up on shares during these transition quarters. So, I'm going to leave you with this final thought to chew on. As NBBK digests these massive acquisitions and navigates what are undeniably rising credit costs, will its unique Builders Bank foundation and hyper-capitalized balance sheet actually be strong enough to propel it past Wall Street's highest expectations? It is a fascinating stock story unfolding in real time, and absolutely one you should keep on your radar. Thanks for joining me on this explainer, and keep learning.